Because you can ask me for my CAGR, let's say like 2 years ago, you get totally different numbers, which is a negative number, right? Yeah.
So I just wanted to ask yourself, like when you were underwater and when you go through that whole process, have you ever like doubted yourself? How do you keep yourself sane?
We can do all the study that we want, but one thing you cannot control is the luck part, the timing part.
So do you think Chinese tech investors right now, are they unlucky or are they misjudging this whole situation?
Actually, looking at your return isn't that bad. People tend to think that, oh, chicken, Chinese bull, look at China stocks, how much it has. So people are having this kind of picture if they don't know you well enough. A number of people, they really do that kind of things that is like textbook things that you're not supposed to do. One common one is really like panic sell.
All right, so we have a fellow friend of this channel, not very foreign to some of you who have been following me. I featured him on quite a few videos and episodes on my channel already. But I think today specifically, there was this very intriguing comment that triggered Boon Tee to write something. And then that particular piece that he's written actually intrigued me further, which was why I called short notice and Boon Tee very readily accepted it. And I think Boon Tee, in my own personal investment journey, for those of you who don't know him, I think he plays more of like a mentor role where he's always there to criticize, he's always critical. He doesn't give face, and then when he wants to question me, he will just shoot it out and he shares his own thought process and his investing and how to look at things differently. I think that's where he had kind of imparted his knowledge through the I don't know how many years that we have known each other for now. But I think maybe just to dive straight into it, right? For those of you who don't know, Boon Tee is a Substack. I'll leave the link in the description below. But there was this very interesting title that he created and said 17.16% return. But here's why it's not the only thing that matters. So I think he has written a very comprehensive piece. It's a very easy read. So I encourage all of you to read through it. But I think before that, I wanted to go to the genesis, which is the starting story of why you created this article. And you wrote it in the first or second paragraph, which is essentially a reaction to a comment on one of our podcast video. And if I may read out the comment said that just a suggestion, make a session of revealing the CAGR, which is the compound annual growth rate of each speaker in 5 years backwards, so we can know the competence of each speaker in investing. So I think just Boon Tee, just to start out, I think when you first saw this comment, right, what was the first thought that come to your mind?
Yeah, I think when I saw that comment, right, I was thinking that, okay, maybe this commentator, maybe he or she, I actually don't know us, don't know for us. It could be your first time that he logged into the YouTube and saw our video and then saw us bashing dividend stocks. Although in the content, actually, we didn't bash the dividends investing. We are more of like just discussing dividend investing, reinvesting. You don't know one, let's say a content creator, you saw the person is giving opinions on investing, right? The first thing that pop up in your mind is that, hey, is this guy credible or not? Is he legit or not? Even when we talk about any other content creators or any other persons, right? Just four of us discussing about what kind of content to make, right? Or who to interview. We also will ask this question, right? Is the person legit or not? Because you can have people who keep on giving opinions here and there, sounds very good, but you look at the person's actual investing, right? It is like all over the place. Like let's say the person didn't really do as per what he shared, right? So that could be it. And most of the time, actually, we don't know because there are some content creators just focus on creating content, not so much about sharing his or her actual portfolio. But I think you and me, Chicken, we're a bit different. We are, I would say, more on the transparent side because like when I share my portfolio, even in one of our last interview also, I just open up the whole thing, then people go and take a look, right? So I think transparency is how we can earn the trust now. So back to this comment, right? Why, like, I just thought that, okay, it makes sense to ask this kind of question. And the person is like, he or she want to kepo, right? Then I was just like, nah, here you go. This is my number. But, and then just to give more my thoughts on like, actually this number isn't that important because you can ask me for my CAGR, let's say like 2 years ago, you get totally different numbers, which is a negative number, right? And doesn't mean that my opinions now or my opinion back then is like coming from two different people's, right? It's essentially from the same person. So I was thinking, okay, let's go into more details and just that like share my views on this CAGR. Yeah.
I think we'll break down a little bit about your own investment journey. But I think before that, I think we have also shared that when we try to find potential people that we want to talk to. We also want to know like how legit it is. And I guess looking at returns is one way. The second way is, of course, to look at their arguments, look at their track record, what they've talked about, and then try to break down their arguments rather than. I mean, these are just some of the factors that we look at. So, for yourself personally, when you want to interview or when you want to talk to someone, you want to develop a deeper connection, what do you usually look at, specifically in the investing space?
I'll say for new friends or like someone new, right? Let's say the person didn't share about his actual portfolios, right? I'll say it's hard to say. Okay, I want to know you better. Can you tell me your CAGR? How much is your performance in the past 5 years? This kind of question is not something that you want to ask before you know the person in details, unless the person really already sharing a lot about the portfolio and comfortable sharing it, right? Then we can of course go into the details. But I would say majority, right? Let's say 9 out of 10. It's quite rare to see people like Chicken, you keep sharing your portfolio in details, right? I think we are definitely in the minority camp. Fair reasons not to share this kind of details. I can understand that. I'm not saying this is compulsory. It's just that when we just know someone, we cannot just ask for these kind of things, because who want to share the sensitive information that the person didn't share publicly, right? So what we can do is really like through asking questions like, how do you invest? What's your belief? How do you implement? How do you execute in this kind of situation? What we will do? What you will not do, for examples. Then from those Q&A, we get to know a little bit about the person. Even let's say we have lengthy discussions for a few hours, I can't even say that we will understand how the person operate, because human minds, right, is quite complex one. Even sometimes we don't even understand ourselves. Like sometimes you will be surprised with what you do, right? Like
This one,
yourself.
this
Yeah.
one, I completely agree. I've talked to quite a few people off
Mm.
both offline and online now. And when you listen to somebody speak, right, sometimes they can give you all the perfect answer. So it's the model answer coming straight out, like printed from Warren Buffett or Charlie Munger, some of the great
Yeah.
investors. Theory and when action, when emotions come into play, when portfolio management come into play, I think it's two different things as well. So which begs the question on, is CAGR important? I think relatively it kind of gives you some level of track record, but also there are other things that sometimes when you talk about investment ideas, for example, somebody can have a bad CAGR but a good idea. So do you
Mm.
mean that you write off everything that he has to say? And then you'll miss the opportunity. Or in some sense, there was this running joke, especially in some of these communities, right? Saying that some people is reverse indicator. But do you mean that, does it mean that you write off everything that he say and
Yeah.
everything that he touch, you don't touch? But evidently there are times that you have good hits, you have bad hits, and some
Mm.
people are just famous for their worst hits because I guess bad news just travels in a way
Mm.
lah. So that's
Yep.
why I thought this whole idea was very interesting, that people judge you purely from a number. I think if
Mm.
you draw parallels to real life, people also judge you by your net worth, right? Judge you by the car you drive,
Yep.
by the house you stay. So that's a very easy like
Mm.
benchmark. But
Yep.
does it really kind of suit the job in terms of trying to know someone? I don't know. I don't know
Mm.
for sure. So that's just that. But then let's talk about the real juice in the story today. So I lift out one sentence from your article. You said
Mm.
17.16% CAGR for the last 7 years. Do you think this return is great? The outperformance is only 2.6% when compared to the S&P 500. Unquote. So Boon Tee just wanted to ask, do you think 17.16% CAGR over the last 7 years is not good, or do you have a deeper meaning behind it?
If you ask me whether I'm happy with this kind of returns, I would say definitely yes lah. Okay,
Okay.
definitely yes. It is a good return for me. I'm happy with that. But I don't have this kind of performance consistently, you know. So, for example, if we just go back, let's say 1 year ago or 2 years ago, you look at the returns, it could be, you know, like let's say I don't know the number actually. Let's say when I look at the number, it's like 2% or -5%, right? It happened right during the crash. I think we just go back to, let's say, at 2022. I think my portfolio invested for like 5 years, still a negative returns. Am I happy back then? Of course, you look at the returns, you are questioning yourself, right? Am I doing all these things right or not? Then we just like take it like, what can I do, right? Market is having downturn. What can I do? But now market is having a bull run and the portfolio looks good. I'm genius. I don't think so. It's just that market has been nice to me, and I just somehow pick the right stocks, right? We know which stocks that we're talking about, right? So good results, be happy, but don't translate that good result to like, yeah, I'm smart, the kind of things, you know.
Hey investors, now you can get zero commission plus zero platform fees while trading US options with Webull by performing a minimum of 100 US options trades monthly with reimbursed fees until the end of September. So if you're an options trader, you cannot miss this extremely competitive deal. You can get 1 month of commission-free trading for US stocks and US ETFs, and 3 months of commission-free US options trading when you open a Webull account and successfully meet the relevant trading requirements. So Webull is known for its low trading fees, intuitive interface, and extremely powerful tools. Webull could be your ideal trading platform. Additionally, for those of you who like to get more cash rewards, I've got good news. So Webull is running a deposit promotion where you deposit minimally 2,000 US dollars and complete 3 US buy trades and maintain it until the 31st of August 2024 to get 60 US dollars worth of cash vouchers. On a much higher tier, you can deposit minimally 10,000 US dollars and complete 5 US buy trades and maintain it until the 31st of August 2024 to get 400 US dollars worth of cash vouchers. Moreover, you can get up to 7% of Moneybull interest for up to 90 days with returns up to 1,750 US dollars. So Moneybull is open to all Webull accounts for you to access it easily. Sign up now and grab your rewards. Don't forget to join Webull and unlock commission-free trading today. Can we just briefly recap on what's your investment philosophy or strategy when you talk about good stocks, right? Or the right stocks that you picked?
When I pick stocks, right, I would say the first criteria is that because I'm like mainly buy and hold investor. I buy and I hold, preferably do nothing for years. And in fact, there are quite a number of my holdings that I have only like accumulate, either now continue accumulate or really stop buying. But rarely, like there's quite a number of positions that I have never sell even like one single shares. I mean, on top of my mind, I can think of like, let's say Apple, Microsoft, TSMC. These are the companies that have never sell a single share. So the first criteria is definitely like I need to be comfortable holding it, like regardless of what's the bad news that come out, regardless of the financials results is bad. To me, doesn't matter. If I have to hold despite the bad results, right, means that I cannot buy a company just because they're showing good results recently. So that means I don't want to act on like short-term things. I want to act on longer-term metrics. For example, their business model, their management, the quality of their business, the mode that they have, and so on and so forth. Yeah.
Is there anything specific? Because episode actually, there were quite a few saying that you're kind of hugging you're a closet hugger, meaning you hold a lot of the QQQ top components back then, even when it was a bear market. And then it does seem like a lot of them are all tech specific stocks. So do you have a process whereby you only look at tech stocks, or it just so happens that all these just float to the top because they are good?
Yeah, maybe the tech side is not really intentional. It's more like I felt that I understand these companies that I'm holding because I'm paying attention to all these things, like reading all these tech news. I mean, typical guys, like usually ladies are happy with their shopping, guys happy with like playing phones, PC, this kind of things, more technology related stuff. And I really like interested. For example, even I just noticed that, for example, sharing all these things with my friends or colleagues, right? We talk about like ChatGPT. I realized that not everyone is like fascinated by this ChatGPT thing. Some of them even like they don't know about it. They don't know how useful it can be. But for me, like, I'm really interested with the capability. I'm interested with how they can generate these kind of things. What's the model running it? Behind the models, what are the infrastructure? What are the chips? And what kind of new chips that enable these kind of things? Give me some comfort of knowing the details of these companies that we talk about.
I think I just wanted to ask also. So this 17% you did disclose, it was MWR, which is money weighted return.
Yep.
Am I right?
Yep.
So can you briefly walk us through what's the difference between money weighted return and time weighted return, and which one do you think is more accurate in terms of representing the skills of an investor?
Yeah, I'll say for as an investor, if you want to put in the effect of like the market timing part, right? So then definitely you have to look at money weighted returns, because whether I buy at different time point, it will have an effect to the returns, right? And you want to put that into the considerations. So money weighted returns is the correct measure. Then the question is, what kind of situations that we shouldn't use money weighted return, but we should use the time weighted returns, right? It is when the investor, or let's say the manager, right, don't control when the money come in. then you need to break down the period and just solely looking at the returns of each period and then just average together all this period and calculate an average return. So for example, right, let's say in institutional investment management, right, usually they will just look at time-weighted returns because you as the investor put money with the managers, right? It's not like the managers say, today I think that it's a good time to enter. Now I get the money from you. It's the other way around, right? Regardless of whether the market is overvalued or undervalued, the moment the investor put the money with the manager will just deploy those money, right? So they don't have control in terms of the timing. So it is not fair if the timing sucks and then you blame it on the managers, right? The managers don't have control on that part. So it depends on the situations. But this part I would say is a bit dry. Like only nerds like you and me are interested to find out the difference between time-weighted returns and money-weighted returns.
Now, if we go into it specific, right? So I looked at the chart, the IB chart that was generated was very nice. And I can't help but actually wonder, right? When I look at the IB chart and you look at the lines moving, right? It's really a very significant, very volatile line, especially the blue one, which dictates your portfolio, right? So I saw this period where from you generated a chart from September 2017 until September, not September, maybe until early 2020. And that part, I think it was a 0% return. So that is a good 3 years, less than 3, slightly less than 3 years. It went up, it went down a bit, it went up, it went down, then it went flat. So that was the first 3 years. And then after, during the 2021 bull run, it basically close to tripled, like it was 160%. So then that was a very short time frame of probably, I guess, within 1.5 years, less than 1.5 years. And then right after that, it went down to the 2022 bear market, right? And then it went down to negative 40%. So mind you, starting from 2017 until 2022, that's 5 years. 5 years of putting in so much money, your hard-earned money, studying the markets, following through, and you have a result of negative 40%. And then right after, of course, right now when we're recording this, it's at a superb run, and then you got the CAGR of 17% per year.
Yep.
So I just wanted to ask yourself, like when you were underwater and when you go through that whole process, have you ever like doubted yourself? How do you keep yourself sane?
I'll suggest, okay, the map, the remember part is really a bit challenging because yes, we can look back the data and try to analyze things and that, right? But you really cannot remember the feeling that well because we tend to forget things, especially the emotional at specific time point in the past, right? But I'll suggest anyone who is viewing, like watching this video, right, just go back to our old, the interview that we did, right? I think that was very interesting because that was the time point when the market bottomed. And I still remember during the interview, there's no sign of market bottoming. We don't know, right? Who can do this kind of timing? So it's really like that kind of mood, right? I still remember it's like we look at the market had already dropped so much, and we probably still think that it will continue to drop, right? And still we stay invested because, like I said, it's invest for the long term. Really, look forward for the next 10 or 20 years, and not just like trading in and out. I don't do that kind of things, right? So the mood part, just watch that old video. You can sense that how sad or how to say demoralizing it is during those kind of period. But that's the things, right, about investing. We can do all the study that we want, but one thing you cannot control is the luck part, the timing part. Because if you get into the market when it's really high, sometimes it's not that obvious. Because if it is obvious, everyone see it, then everyone can time the market because market timing become genius. But the thing is, it is very, very unpredictable. So if you talk about like, let's say 2 years, 3 years, 5 years, these are short period, right? It's really subject to the luck. Like if you're unlucky, you get in let's say 2021, and then you just experience the bear market. Then you just look at your money all like gone, right? What can you do? You cannot do anything. The only things that we can do is really like come up with a system and then try to find ways to make us like be disciplined, like something that help you be disciplined. For example, let's say we talk about like DCA, like dollar cost averaging. I don't think dollar cost averaging can really like outperform. It is not meant to outperform. It's meant to help you to stay invested and stay disciplined, because you are saying that, okay, regardless of market up or down, I continuously put money into the portfolio and continuously just execute my strategy. Just the discipline part, I think is very important. So that part really, if you think that okay, market drop is okay, then I buy more shares, right? Just spending the same amount of money that put into the account, I can buy more shares. So that help us emotionally and help us focus on what is important, which is the investment part. Because we know that over short term, right, 3-5 years, it can go up and down. But over, let's say, 10 to 15 years, you will see that the drift of the market will trending up. And this trending up is not like, oh, magically it should go up, then it go up. It's not like that. It's really that you look at the portfolio, underlying the portfolios are all these investment, underneath all these investment are businesses. And hopefully you are buying businesses that make money, businesses that generate free cash flow, businesses that reinvest into themselves and make the companies become a better version of themselves. So they grow over time, right? That's how we profit as a shareholder. That's the more important part. But you really have to tide through this, like the 3-5 years, and just hold for 10 years, and you can see that actually, okay, slowly your money has compounded, right? So that's the result they want to see. But it's difficult because the moment you put your money into stock market, you are seeing the plus minus, the P&L, right? And can you take that kind of P&L or not? So that's the challenges that we are all facing as an investor, especially if you are heavily concentrated in a stock portfolio.
I have a follow up to that idea of feedback loop, right? But before
Mm.
that, I think I just wanted to sidestep a bit. I wanted to ask, I'm not setting up a trap for you. I just want to hear your own opinion, right? So, do you think Chinese tech investors right now are they unlucky or are they misjudging this whole situation?
I've been asking this myself, these questions myself. I really don't know, because I'm thinking that, okay, let's look at the range, right? Because first accept that we all don't know, okay? We are all making predictions of the future. So where's the how to say, if it turned out well, how well can it go? And then if it turned out badly, how badly can it go, right? And I'm not talking about like share price, like I'm predicting the share price. I'm predicting the overall macro environment plus the micro environment plus politics plus geopolitics, everything. Just try to visualize the future, how will it look like over, let's say, 10 years, right? And I can come up with like different version of the future that can turn out true, right? For example, everything turned out well is a picture where, oh, suddenly people realize that actually China governments, they want the economy to do well, they want the capitalists to do well, they want the businesses to do well, they want everyone to become rich. So then we all realize that, oh, all these bearish things about China market is all temporary. That is the best shopping time for the investor, and those who didn't buy Chinese stock are all like stupid peoples, right? So that could be one like bullish story that can turn out to be true. And I can also tell a story of the other way around. For example, that, oh, this whole thing about punishing capitalists, the common prosperity, Chinese businesses are forced to do common prosperity things, and all this, free cash flow that they generated is used for other things that doesn't benefit the shareholders, right? And this one can also drag on for, let's say, 5-10 years, right? And in the end, if this continue, it is possible that investors are not willing to give a high multiple. So whether you buy it at, let's say, 10x multiple, it could turn out to be 6x multiple 10 years later, right? It can turn out to be true also. So the range of outcomes, right, could be, there's a very optimistic one, there's a super pessimistic one, and it can turn out to be at any point in between, right? The end, right, I can share with you. Actually, I don't know. Sometimes I'm just like convincing myself that the upside is true, and then the other day I kind of thinking that, okay, yeah, things really don't turn out well because of the situation, the data point that we are watching. For example, economics still suffer and so on, right? So I'm back and forth. That's why sometimes when I debate with you also, I find it quite interesting, because I like to have this kind of like just debate sometimes, maybe for the sake of debate, but just spark some imagination of what could turn out to be true. And we are all playing guessing game here. I don't have a picture that convince myself that, okay, there's one version that's only right. I really don't know. And I do these kind of things on quite a frequent basis, and not only on Chinese stocks. It's all on everything's.
Also, right, from my
Mm,
understanding, so how I look at you allocate your capital right now is okay, you can talk about a lot of the upside, but you're not
mm,
totally bought into it. But that said, you're also not completely out of it. So you still have a few positions here and there, and you try to see that, okay, lah, if I just bet a bit, if it goes up, then it goes up. If it
mm.
doesn't go up, then so be it. Anyway, it's less than, I don't know, 3-5% of your portfolio.
Yeah,
So anyway, hits you win, tails you don't lose much.
yeah.
I guess that's the methodology now.
Mm,
So I think cycling back, right, when you accustomed to the idea where everything we do from young, I think education, we study something within the next half a year, 1 quarter, you need to do a test. And then there's this feedback loop that reinforces whether your study side habits is correct, whether you're listening to teacher is it correct, the way that you are learning. So there's this feedback loop. But then that's the exact problem with this idea of investing is because if let's say you're very unlucky, you enter at the top, and I think even if you drag back to the US history, there are times where it took them decades for the stock to even come up, especially if you don't dollar cost average down. So then the feedback loop is so long to the point where a lot of people just give up and say that, oh, this is a scam. I think there is a lot of older folks that are still in the mindset that investing is a scam, it's gambling, etc. So that was the worry there. Then I think when I reflect back on this idea, right, I also don't really know how to describe this. Because like you said, right, if the thing or if your thesis is right, in the range of outcome, you are more right than you are wrong, then people say that, oh, you're a hero. But if you're more wrong than you're right, then people say you're a zero, or your analysis no use, you can't look into the future, you're not visionary. And especially when you're trying to tide through this feedback loop, right? I don't know what is it called. It could be stubbornness, it could be arrogance, it could be confidence, it could be ignorance. So to you, how do you manage your own thing saying that my system is okay? I think this is okay. How do I stick to my guns? Maybe even advice for myself, because I guess I have been on this Chinese tech ship for quite long. And it's like it goes up, it come down, it goes up and come down. And then I mean it stays submerged for now.
Yeah.
So I don't know how do you position yourself? How do you look at this whole situation?
Yeah. I'll say first thing is that actually, let's say looking at your portfolio, like Alibaba or other Chinese companies, right? Actually, looking at your return isn't that bad. People tend to think that, oh, chicken, Chinese bull, look at China stocks, how much it has dropped from how many percent down, right? So people are having this kind of picture if they don't know you well enough. But if you look at your portfolio, your returns, it isn't that bad. It's actually, maybe when you are ready, you can share your returns with I mean, your audience. I don't think your returns isn't that bad. So that's one thing. Okay, come back to the question you asked me, right? First thing I would say, yes, we all can check our returns because it's so convenient. Okay, for me, I don't even need to calculate the numbers. It's just there, IBKR send to me this kind of report on a daily basis. I click on it, that's the returns there. But do I check this kind of returns like frequent basis? Actually, no. Of course, I will roughly know where it is because I'm paying attention to the market. When market ready, I know. So I roughly know where is it. But I don't check on the number on like regular basis because I know that like these returns, because there's so much luck, so much timing inside it, right? It's not like it's not worth to say, okay, the return is high, then I'm doing it right, or if the return is low, I'm doing it wrong. So I tend to like how to like really detach it away and don't focus too much on the returns. Of course, the returns play an important role in determining how much like the size of my portfolio, let's say 10 years from now. If I get, let's say, a negative 5% versus a positive 15%, is like huge difference. But I just don't want to think of like that's how I get validations, that I need the market to treat me well in order to say, okay, actually I'm good. So you need to like dissociate from the return. So that's the first step, right? Then the second thing is that, okay, if you don't look at the returns, then how do you get this kind of validations? Like, how do you know you are right or wrong? I would say maybe don't focus too much on like getting the validations. It's more like I don't want to like have a need to tell myself that I'm doing things right. I'm more like, okay, I'm picking these companies. Okay, say for example, your friend opened a restaurant, right? And you invested, let's say you get a quarter shares, right? So you already have your money, your stakes is already with the companies, right? And what we want to do is just hope that the companies turn up well. So by turn up well, I mean it perform better than what is being priced in. So if you buy a companies because you think that it is a growth stocks, you think that it makes sense. Let's say you think that given the valuations, market pricing in, let's say 15% growth, and it turned out to deliver 20% growth or 25% growth, that's to me is good, right? So for me as an investor, or rather like a business owner, like partial business owner, owning 0.0000001% of the companies, right? So I just want to, hope that the companies will do well. And those are the metrics that I'm tracking. So if you notice, let's say if I do some sharing on my channel, right? Usually I don't like talk about individual companies that often because actually, to be fair, I don't do this kind of in-depth analysis that frequently. But sometimes I would take a look at the company. The first thing I look at is all these, the fundamentals metrics, for example, their revenue growth, their free cash flow, their earnings, track all these things. If all this turn out well, right, high chance is that the share price also will be rewarded. But this is not one to one, because sometimes it's like valuation can drop because of macro, because of interest rate, because of all sorts of reasons, right? But that one also we cannot control. But what we can, how to say, like bet on, right, is really like, okay, these fundamentals will turn out well. So this is the things that I observe. And even if it turned out badly, right? Say for example, I buy a company, so I thought that okay, revenue will be growing, but the revenue just dropped, right? Then it is, I would say that that's okay, lor, the company's doing that not well. uh, uh, there's a subtle difference, right? The company's doing not well and not me doing not well, because I'm betting on many companies, right? Let's say a few of them not doing well, to me it's still okay.
Actually, you did talk about this concept, right? Quite a few
Mm.
times already. And you were saying that actually your investment objective was not to beat the market.
Ah.
And this was very interesting. So you said that because not beating the market, that was your first line. And then the
Mm.
second line, the subsequent paragraph, you said that, but you think that you have a few edges. And then you outlined a few bullet points,
Mm.
saying that you have a behavioral edge.
Mm.
To me, when I read it, I feel that this guy is talking, is BSing me. You know why? Because in what concept then you talk about
Mm.
edge is when
Mm.
you are trying to beat something. That's why you talk about I have an edge.
Mm.
So I feel like I don't know whether it feels a little bit disingenuous to me, but I think
Mhm.
at the end of at the back of your mind, you're probably still targeting to win the S&P 500 in the long term.
Not
But
really.
you're just writing it. No,
Maybe it's poor writing, I would say. So the age, right, that I meant, right, is not the age in beating the market. The age is like, my age is like beating the life game, you know. This entire portfolio is not meant to beat the market. It's meant to serve my retirement. So I can underperform the market, and if my life turn out well, then I still win. So that's the edge that I have. You know, the edge is more like how to say, like if you just observe, right? This one I think I find quite interesting. If you observe people, some people invest in stock market, some people don't. Some people trade the market, some people don't. But regardless of the person is trading or investing, if you look into the details, right? If you have close friends, you just observe their behavior, right? I'll notice that quite, I won't say everyone, I would just say quite a number of people, they really do that kind of things that is like textbook things that you're not supposed to do. One common one is really like panic sell. This is so common. Even I myself also panic sell my meta, and now you can laugh at me. So that's, to me, is like, but people do this very often. And if you track the results, right, this one I will give some credit to IBKR, where, you know, if you have IBKR portfolio, you really have no excuse to say, oh, I forgot how much I lost. You know, I have this kind of problem before I invest in US market, because, you know, the older platforms, right, really don't keep track of my transactions. So I really don't know, like, I lost money, I don't know how much, the kind of situations. But with IBKR, right, everything is tracked. You can look at your really your transactions and tell yourself, like, okay, do you actually know what you're doing? Like, do you buy low, sell high, or what kind of things that or buy high, sell low, right? So you can look at the details. And I still think that there are many people, they are, when it comes to, like, let's say stock investing, they don't have results that just, you know, track the market. Like, I would say quite like majority, or maybe like more than half of the people actually don't even beat the market. That's one big majority. And then the other, let's say half or more than half of the peoples, right, they don't even invest in the market. So they end up like just putting their money in, let's say, like uh, FD or treasury bill or money market funds. And this group of investors, it's not like they are bad. It's just that maybe they don't have the appetite, which then you have no choice, or they just don't, you know, like put the money in the asset class that have the potential to give you like really decent returns, right? So they stay away from the market, and we all know that market, if you stay away for a very long time, the problem is that your money will, you know, depreciate because of the inflation, right? So if you do this long enough, let's say like 20 years, 30 years, you will notice that by the time you retire, actually you don't have enough to support your lifestyle, especially if you need to support yourself for, like, let's say 40 or 50 years. We are talking about, like, you know, longevity risk now. So I would say for those who are young, you still have some advantage, because if you've learned now, learn the right way to invest, you can still benefit from the equity risk premium. I think equity risk premium is still there. We can all debate about the current equity risk premium is maybe like lower. It's more towards, let's say, 4% instead of like 6%. Then why we can debate, right? But it's still there. You still can have the outperformance versus the other asset class. Maybe more than half of the people, they don't take advantage of that. So to me, that's a problem, and that's the part that we all play some role in, like at least encouraging people to be comfortable with taking a bit of risk, have an asset allocations, invest in companies, invest in the correct way, invest in business, not like doing trading, speculations, and so on.
Maybe just a small point before we conclude the video, right? I'm in your group, and as you all know, you run a Telegram group as well. And then in your group, I think just yesterday night, not yesterday night, today morning, yesterday night, you posted a screenshot of a daily PNL, and the daily PNL is in a negative of north of 20,000-30,000, like
Yeah.
single day PNL. I was thinking, I'm not too sure what's your monthly income, but I'm not too sure whether this is more than 1 month of your income.
Definitely
But
multiple months.
okay, so when you look at this kind of 5 digit, like 20, 30K, 40K drawdown in a day, I don't know how many days this rate will continue.
Yeah.
Does it still affect you mentally after playing this game for more than 7 years?
No. Like I look at it,
Totally.
I just
Zero.
smile only. Actually I posted that is really, how to say, okay, maybe this kind of number, just go back to, let's say, 3 years ago, it still shocked me because, when I just started, right, I also put in money like 1,000, 1,000, 1,000 every year. Then it started like every month, try to put in like 2,000, 2,000. So I built my portfolio, also started from 4 digit, then go to 5 digits, right? That's how we all build our portfolio. It doesn't start from right away 500K. Not like that one, really. So the portfolio building really takes time. So the volatility, right? Like yesterday, that kind of returns is really a few percentage points. So I know that this daily volatility, like daily loss, how much can go, right? It's really is a function of my portfolio size. So if 3 years ago, 4 years ago, I look at this number, maybe I was shocked and really like concerned. But after you play like long enough, you are comfortable with, let's say, one day drop, let's say 1,000, right? Then slowly you are comfortable with 5,000. Slowly you are comfortable with 10,000. Now I look at like drop by 20 plus thousand, right? Actually, when I share, I just want to share this and then followed by the meme things like, "Hey, I lost my saving again." So it's just like a joke to share around, like make the group more, like people laughing over these kind of things that don't stress out lah. And I try to bring in, like, actually you can look at this and don't be concerned about it and just laugh over it. So that's my my intentions lah. And this is like a progress. I see this as a progress. It's not just about like laugh and then for entertainment only. So now I'm comfortable with 20K. I can smile. I hope that one day, even my portfolio drop by, let's say, like 100,000, I can still have this kind of a feeling that, oh, we can just laugh over it, no problem, no concern.
I think that's a very good roundup to this entire discussion, right? So I think I just wanted to make a quick conclusion, also just to echo what you talked about on your Substack as well. You said that creators put out facts and opinions, and you as a viewer should come to your own conclusions. And at the end of the day, even though Boon Tee said that he has 17.6% per annum, how are you going to verify the records? Because he didn't hire, you can't have access to his portfolio. He didn't hire accountant or the Big Four to do an audit or whatnot. So at the end of the day, I think creators like both of us, we can only build trust by being transparent and by sharing not only in the good times, but also in the bad times.
Yeah.
And like myself, I think the last 3 years has just been bad times for me. There was no good times. So that's just besides the point. But I think maybe also your quick take on what do you think are the responsibilities of maybe creators when coming to so-called influencing other people's investment decision, especially when you talk about specific stocks or you say that you talk about this analysis, you can analyze really, then at the end say that it's a good call, bad call. What's your thoughts on this?
Yeah, I think creating content is hard enough. As anyone, right? Let's say if you want to be a content creator, you just be useful. I think that's good enough already, because we all have our own commitment. We are not, any content creators are not like have these obligations to do anything, right? So we can just shut our channel and just run away. I think no obligations there. So anyone want to be a content creator, as long as you are being useful to the members, to the viewers, I think that's like good enough already. And this is a high bar, because so yeah, I would just say be useful. That's what I myself striving for. At least help someone. That's enough. Yeah.
Last question. What's a key lesson that you think you hope that you have learned earlier?
I would say really spend the time to just accumulate the knowledge. So that include like readings, watching. That's the part that it won't be wrong, lah. But really spend your time, read quality stuff, watch quality stuff, take it seriously, lah. So that's my closing statement.
Okay, thanks Boon Tee once again for coming on. Maybe next time when it's in the seven figures, we'll invite you on again. And I don't think it will be very long before you'll come back on. So with that, we'll see you guys in the next video. Goodbye.
Bye bye. Wow, so long ah? How long ah?